Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back to the Deep Dive. Today, we are taking a scalpel to one of the most powerful and certainly one of the most complex tools in the corporate world, mergers and acquisitions in M&A.
It's a huge topic.
It is. And if you're watching these corporate giants reshape their industries, you really need to understand the blueprint. So our mission today is to give you a complete, clear-eyed view of the full M&A lifecycle.
We're basically going to unpack the standard 9-phase process.
Exactly. And we're drawing directly from the framework provided by Financial Edge, which really guides these massive corporate shifts.
And that's a good point to start because setting the stage is crucial here. While this detailed 9-phase process is the gold standard for large, complex deals.
Ones with all the investment banks and legal teams.
Right. It's important to remember that for smaller deals, maybe in the lower middle market, this whole process is often streamlined. They might, condense a few steps.
But to really get the risks and the opportunities, you have to understand the full playbook. So let's unpack this 9-phase journey, starting right at the beginning, in the boardroom.
Precisely. Phase 1 is all foundational, building the M&A strategy and implementation plan. This isn't just about spotting a cool company to buy.
So what actually kicks the whole thing off? Is it just a good idea, or is it more of a calculated deficit?
It's a calculated necessity. The board sets a long-term strategic plan, maybe a 3 to 5 year vision. They have very specific revenue and net income targets.
Okay.
And if management looks at their organic growth and says, we can't hit those numbers, that's the trigger. An acquisition becomes necessary to fill that gap.
So that's the buy-side trigger. The need for growth is demanding outside resources.
Exactly. And the buy side then meticulously documents its criteria. I mean, the specific sector, the target's revenue size, geography, the maximum valuation they're willing to pay.
A whole shopping list.
It's a profile of the perfect partner before they even start looking.
And what about from the seller's perspective? When does a company decide to put itself up for sale?
That's the sell-side trigger. It's usually one of two things. Either the majority owner decides it's time to cash out, or the board determines that selling off a certain business segment will actually maximize overall shareholder value.
I see.
And at that point, they bring in bankers to do evaluation and, very importantly, create a list of potential buyers and an outreach plan.
And what's critical here?
At this stage, this is all internal. There are absolutely no regulatory filings required.
Okay, strategy set, criteria established. That brings us to phase 2, the search process. This is where the investment banks really earn their keep, right? They're not just advisors anymore, they're scouts.
They're the eyes and ears of the industry. Investment banks are in constant dialogue with CEOs, with CFOs. This gives them, non-public insight into who might be facing succession issues or which private companies might be receptive to an offer.
So they're leveraging relationships to build that first list.
Yes, a very long list.
Yes.
Then they relentlessly refine it against the financial criteria from phase 1. But here's an essential insight from the Financial Edge framework.
Okay.
The process places a special emphasis on assessing cultural compatibility.
Cultural compatibility, that feels a little squishy next to something like an EBITDA target. Why so early?
Because it can kill a deal later. If you have a risk-averse bureaucratic company trying to merge with a lean, aggressive startup,
it's a disaster waiting to happen.
the integration will fail, period. It doesn't matter what the financial synergies look like on paper.
Yeah.
So you have to start assessing that fit right at the screening stage.
Fascinating. So that brings us to the money question. Phase 3, business valuation. How do you possibly figure out what a company is worth when everything feels so uncertain?
Well, you're right. Valuation is inherently imprecise, which is why relying on just one number is a fatal mistake.
So you use a bunch of different methods.
The standard process dictates using multiple methodologies to kind of bracket the value. But we're talking trading comparables, what similar public companies trade for, transaction comparables, what similar deals have closed for, and of course, discounted cash flows, DCF.
Okay, let's drill down on the DCF, because that's where a lot of the educated guesswork happens. The framework says you use it in two ways, standalone versus with synergies. What's the difference?
A huge difference. The standalone DCF values the company exactly as it is today. It's the baseline.
Got it.
The DCF with synergies is totally different. It adds in the projected value that's only created by the combination. Cost savings, cross-selling opportunities.
That's a justification for paying a premium.
Exactly. The buyer uses the standalone value to make sure they're not overpaying, but the seller points to the synergy value to demand a higher price.
So you have all these different methods giving you different numbers. How do you make a decision?
Right, you get information overload. And this is where a great visual tool comes in, the football field chart.
The football field chart. I love the name. What does it do?
It just visualizes the entire range of values from every method on one graph. You see the highs and lows from your trading comps, your transaction comps, both of your DCF models.
So it stops people from getting fixated on one single number.
Precisely. It prevents anchoring bias. You see the credible, defensible range, and in a negotiation, you can point to the chart and justify why your offer sits where it does. It just reduces the scope for error.
Makes sense. Okay, that brings us into Section 3, where things get serious. Phase 4, first contact.
And this step is all about paperwork designed to preserve secrecy. First thing, absolutely non-negotiable, is the confidentiality agreement, or CA.
And why is that secrecy so vital for the target company?
Because a leak about a potential sale is corporate poison. The CA is a legal shield. If employees hear a sale might happen, your best people might leave. Suppliers might get nervous about future contracts. Lenders might even reassess your credit terms. The CA lets the business operate normally while these talks are happening.
Okay, so once that trust is established with the CA, the buyer sends over the initial terms. I see term sheet and letter of intent, or LOI. What's the difference?
A term sheet is usually a brief, non-binding outline, maybe 2 to 4 pages, purchase price range, assets involved. Pretty simple.
And the LOI?
The LOI is much more formal, with detailed legal language. And while the deal itself isn't binding yet, the LOI often has binding elements, like an exclusivity clause.
Meaning the seller can't go shop the deal to other buyers.
Correct. And it also defines the scope of due diligence and who pays for what.
And even at this early stage, you could trigger some regulatory attention.
You can. If a buyer acquires more than 5% of a public company's stock, maybe to signal intent, they have to file a Schedule 13D with the SEC within 10 days. That's a huge red flag to the market that M&A talks might be happening.
Which takes us right into Phase 5, due diligence and deal negotiation. This is where it gets really interesting.
This is where the pressure is immense. After the CA is signed, the buyer's team gets to review everything. Audited financials, unaudited financials, customer contracts, litigation history.
They're looking for skeletons in the closet.
That's exactly right. This is the buyer's last chance to verify everything the seller has claimed. And material risks are found more often than you'd think.
So what happens if they find something? An undisclosed liability or maybe overstated revenue?
It can kill the deal. It gives the buyer the right to renegotiate the entire structure, or more often than not, just walk away. Due diligence failure is a primary reason deals die late in the process.
Okay, but assuming due diligence goes well, you get into the intense negotiation. The price is obviously central. But what about the deal structure? I see cash versus stock is a major point.
It's the ultimate negotiation because it's all about allocating risk and tax liability.
Walk us through that trade-off from the seller's side.
For the seller, cash is great. It's immediate liquidity, it's certainty, but you incur immediate capital gains taxes. Right, if you accept stock, you defer that tax liability, which is a huge plus, and you get to share in the potential upside of the new combined company.
But you're also taking on risk.
A ton of risk. You're exposed to the integration, the market performance. You're betting on the buyer's ability to execute.
And for the buyer, why pick one over the other?
For the buyer, a cash deal often means taking on acquisition debt, which strains their balance sheet. Using stock preserves cash, but it dilutes your existing shareholders.
So what does it signal when a buyer uses a lot of stock?
It could be one of two things. Either they want the seller to share on the risk, or they are genuinely confident that the combined company is going to be a huge success.
And I imagine there are other non-financial terms being hammered out too.
Oh, absolutely. Things like board representation, management retention contracts, retention bonuses for key employees.
Yeah.
These are the protective clauses that ensure continuity.
Right. Okay, so we've cleared the major hurdles. Phase 6, deal announcement. When does the world finally find out?
For public companies, the deal is formally announced when they file an SEC Form 8K. It discloses the definitive purchase agreement, the final price, the structure, and the market reacts instantly.
And these agreements often include a breakup fee? That sounds weird. Why would you pay someone to break a deal?
It's not a penalty, it's an incentive to commit. The breakup fee says the acquirer has to pay the target if the deal fails, because the acquirer couldn't meet a condition, like getting their financing in order.
Ah, so it keeps the buyer honest.
It incentivizes them to fulfill their commitments.
Okay, phase 7. Post-announcement due diligence and the integration plan. So the work isn't over.
Not even close. This is happening concurrently. While lawyers are getting regulatory approval, the operating teams are now deep in the weeds, verifying data and planning the really brutal work of integration.
Aligning IT systems, merging workflows.
Identifying redundancies, managing employee retention. The planning here is critical. This is where most M&A deals actually fail in poor integration.
Which brings us to phase 8. Deal closure. The legal finish line.
This is the official transfer of ownership. It requires final executed agreements, shareholder votes from both sides, and critically, getting all the necessary regulatory approvals.
Antitrust stuff.
Exactly, from bodies like the Federal Trade Commission or the European Commission. Then a final 8K is filed, and the deal is legally closed.
The deal is done, but the work, and maybe the biggest risk, is still ahead. Phase 9. Implementing post-closing integration and evaluation.
Right. Integration isn't just about merging systems. It's about actually realizing those synergies that you use to justify the price in the first place.
And merging cultures, which is even harder.
Much harder. And the final essential step in this framework is what Financial Edge calls the stop, assess, and learn phase. The company looks back at the performance against the original goals from phase 1.
To see what worked, what didn't, and what they can do better next time.
Exactly. It's about institutional learning.
That full 9-step journey, it really shows M&A isn't a quick transaction. It's a complex strategic campaign that demands precision from start to finish.
The conclusion is undeniable. Success isn't just about finding the right price. It's dictated by rigorous planning, using tools like that football field chart to manage complexity, and then just executing a meticulous integration.
And understanding the structure is vital for anyone analyzing corporate strategy or even just reading the business news.
And here's a final provocative thought for you to chew on, related to that cash versus stock decision we talked about.
Okay.
When you see a major deal announced, and the buyer is funding it mostly with stock, ask yourself what that really signals. Is it a sign of the seller's deep confidence in the new company's future, that they want to be part of the upside? Or is it purely a financial move by the buyer to conserve cash and shift the integration risk directly onto the selling shareholders? It's a subtle signal, but it really tells you where the long-term risk truly lies.
Something to think about. We'll see you next time on The Deep Dive.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.